Welcome back to the Longacres Finance channel. Today I want to take a look at the Dividend Snowball for long-term investors in Lowe stock. Lowe's is the second largest home improvement retailer in the United States, but it has an equally impressive return history as Home Depot. If you don't believe me, stay tuned and find out. I'll make a comparison between the two companies at the end of the episode. I love the idea of turning small amounts of money into large sums of money with little effort on my part. The best way I know how to do that is to invest in quality dividend growth stocks over a long period of time. Most people think it takes a large sum of money to invest and build wealth. And to some extent that may be true. If you invest a large sum of money, it'll give you a higher cash flow today. But the most important factor in investing isn't the money, it's time. If you have a long enough period of time, you can build great wealth with small sums of money. How small, you ask? How about $20 per month? That should be a pretty small amount of money for the average person to set aside each month. You can skip one Starbucks coffee each week, or simply set aside $5 per week. $20 per month is $240 per year. Now you may be wondering how this small sum of money can grow into great wealth. And what exactly does great wealth mean? It could mean $10,000 to some, or maybe $100,000, or maybe even $1 million. You shouldn't overly concern yourself with how much it can grow to, but rather focus on setting this money aside and investing it. And if you can set aside and invest more, that's even better. Let me show you exactly what investing $20 each month into Lowe stock over the last 37 years looked like. Before we jump in, if you're enjoying the video, please give it a thumbs up and subscribe to the channel. It'll really help me out. So your first $20 investment into Lowe's back in January of 1985 would have given you about 23 shares of stock today. Now you wouldn't actually buy 23 shares in 1985. You'd actually be able to buy less than one share with this amount. But through the stock split since 1985, your original purchase would turn into a little more than 23 shares today. Lowe stock trades for somewhere around $230 today, which means your first $20 investment would be worth about $5,300 today. That's an astronomical growth rate of more than 26,000%. Lowe's also currently pays a quarterly dividend of 80 cents per share. So your original 23 shares would give you about $220 of annual dividend income. That may not seem like a large sum of money, but it's actually 11 times your original investment that you would now receive each year. And since Lowe's is a consistent dividend grower, it's likely this annual sum will only increase in the future. If you consistently invested the same $20 amount into Lowe's each month, starting back in 1985 and continuing on until today, the market value of your investment without dividend reinvestment would be worth about $644,000. To me, that is a huge sum of money. And all it took was 441 monthly investments of $20 that amounted to a total investment of $8,820. In addition to having this $644,000 investment, Lowe's would have paid you just shy of $46,000 in dividend income since 1985. Just this dividend income alone would have returned your total investment 5 times over. In fact, Lowe's would have paid you more dividend income per year today than your total investment in the stock. As this dividend income trickled into your brokerage account over the years, you could have either spent it, or you could have reinvested it back in the stock. Had you opted for the latter, the market value of your investment would be worth about $283,000 more today. That's right, you'd have about $928,000 instead of $644,000, just by opting to reinvest the dividend stream instead of spending it. And you would have received an additional almost $15,000 in dividend income along the way. Obviously, reinvesting your dividend income seems like a no-brainer, especially if you have a long-term investing horizon. It not only results in a larger portfolio value, but earns you more dividend income in the future. This is the power of compounding, and the longer you let it work for you, the more rewarding it'll be. To me, turning a $20 investment per month over a 37-year period into almost $1 million is the perfect example of turning small sums of money into great wealth. Lowe's may be a better than average example, because the stock had a pretty impressive return during this 37-year period. It had a compounded annual growth rate of about 16 to 17%, depending on whether or not you reinvested the dividend stream. Whether the stock can offer the same growth rate during the next 30 years is unknown. It could do better, or it could do worse. If you're scared of what to invest in, but you'd like to invest $20 per month into a dividend growth stock, why don't you break this sum up and invest $5 into 4 different stocks? Investors today have the advantage to invest small sums of money into numerous stocks. Your parents or grandparents didn't have this option back in 1985. Back then, you'd have to call your broker on the phone to place your trade. That would probably be executed a day later, and you'd probably have to pay a $20 fee just to process this trade. Talk about hampering your returns with fees. It's unlikely that anyone was investing $20 per month back in the 80s. You'd essentially be paying a 100% fee on your investment. Today, you can actually buy 20 different dividend growth stocks with a $20 monthly investment on brokerages like M1 Finance. FYI, if anyone would like to open a new account on M1 Finance, I have a referral link in the description of this video. If you use it, we will both receive a bonus. Let's go back to the Lowe's example for a second. There are a few important lessons to take away from this example. The first is to start investing as soon as possible, to have the longest possible investing horizon. It's likely that the first money you invest will grow the most, since it will have the longest time to compound. Second, you want to stay consistent and develop a habit of setting money aside and investing it. It doesn't matter how small or large this amount is. Anything you invest in today will only benefit you in the future. But really, the investing horizon is probably the most important factor. If you can invest over 30 or 40 years, the odds that you'll be able to grow small sums into great wealth are pretty high. Not every stock will offer the same returns, which is why most advisors recommend that you diversify your portfolio across multiple stocks and sectors. I'd like to use the Lowe's example to show you what role time plays on building wealth. The way I'll do it is to show you just how much more you need to invest per month to have the same final market value over a shorter investing horizon. In my original example, the first $20 investment was made in January of 1985. So let's take a look at how much you'd need to invest per month if you started 5 years later, in January of 1990. And that monthly amount would be about $44. It doesn't sound like much more than the original $20, but it actually is a lot more. It's more than double the original amount, just by trimming the investing timeline by 5 years. It also almost doubles the total amount you'd invest in the stock from the original $8,820 to $16,808. Let's trim another 5 years and see what happens. Now your first monthly investment would be in January of 1995, and you need to invest $147 per month to have the same market value as the $20 monthly investment 10 years earlier. The total amount invested also increases to $47,334 from the original $8,820. You can see how the necessary investment amount grows almost exponentially as we trim the investing timeline. Let's take a larger leap of 10 years now to see how that changes things. Now your first investment would be made in January of 2005, giving you just shy of a 17-year investing timeline. That's a little bit less than half of the original almost 37 years, and you would need to invest about $541 per month to duplicate the original example results. That's a total investment of $109,282 during the last 17 years, compared to $8,820 over the original 37-year timeline. That's a pretty drastic change, and $541 a month sounds like a big chunk of money. I doubt the average person can consistently set aside the sum of money each month for 17 years. So trimming your investing timeline will result in either a smaller final value, or will require larger monthly contributions. The 5-year shorter window doubled the necessary monthly investment amount. A 10-year shorter window required more than 7 times the original investment amount. And trimming 20 years from the timeline increased the monthly amount more than 26 times. The point here is to start soon and stay consistent. In the beginning of the episode, I mentioned that I would compare Lowe's to Home Depot, so let's take a look at that comparison now. Investing $20 per month into Lowe's gave us about a $644,000 market value without dividend reinvestment. Investing $20 per month into Home Depot would have worked out a little bit better. Without dividend reinvestment, you'd be looking at a market value slightly over $1 million. With dividend reinvestment, you'd be looking at about $928,000 with Lowe's, and almost $1.6 million with Home Depot. Home Depot would have also generated more dividend income along the way. With Home Depot, you'd receive about $111,000 of dividend income without dividend reinvestment, and an additional about $46,000 with dividend reinvestment, while Lowe's would have paid you about $46,000 of dividend income without dividend reinvestment, and an additional about $15,000 with dividend reinvestment. You would need to invest a little more than $31 per month into Lowe's to duplicate Home Depot's market value, and an even higher monthly amount to duplicate Home Depot's dividend income. So if you aren't invested yet, today would be a good day to start so that your investing horizon can be as long as possible. And if you're not sure what to invest in, you can check out some of my other episodes to get more dividend investing ideas. And if you don't feel comfortable selecting your own stocks, then you can always invest in broad index funds or exchange traded funds. The stock market almost always helps grow your investment if your investing horizon is long and you pick a good investing strategy. Good luck out there. That's it for today. Thank you for watching. Don't forget to subscribe and see you next time.